Hello and welcome to Crossing the 49th, the Cross-Border Tax and Financial Planning Podcast. I'm your host, Phil Hogan from Beacon Hill Wealth Management, and today we're going to talk about U.S. state returns for Canadians. Okay, so today we're going to talk about U.S. state tax returns for Canadians. Now, as we know, the Canadian and the U.S. tax system are organized quite differently. In Canada, we have federal returns and provincial returns, and for most cases, provincial returns are included within the federal return when you prepare the return. So when you're using a piece of software to prepare your Canadian returns, unless you live in a province like Quebec, you will complete your federal return and it will auto-complete your provincial return. You might have to go in and do some additional calculations for provincial tax credits that you might not get on the federal side, but for most cases, it's quite integrated. That's quite different from how the U.S. system's organized. So we have federal tax, obviously, but then we have individual state taxes for each individual state. Not only that, some states have income tax and some states like Florida and Texas do not have income tax. So this has come up a lot in the last couple of years as we've seen quite a big migration from states like California and New York into places like Texas and Florida. So then the question is, why would Canadians have state tax filing responsibilities? So that's going to be the conversation today. And then we'll also talk about how you would file your state tax returns if you're in the US and you're moving to Canada. So if you're living in California and you're deciding to move to Canada permanently. But let's first just talk about when would a regular Canadian, non-US person, living in Canada, why would they need to file a US state return? So once again, I do want to preface this by each state is completely different in how they handle their filings. State tax returns can be quite straightforward, or they can be quite complex. So every state's going to be very, very different. So just recognize that. And it's honestly going to be quite difficult for, regular everyday people to file your state returns, just because in most cases, they do require pretty good software to get through some of these returns. So I would always caution against doing it yourself, get a competent cross-border advisor to help. But why would Canadians need to file state returns? So for the most part, income from the U.S., income from interest, income from dividends, capital gains, obviously, and even certain amounts of business income won't necessarily be taxed. It won't be taxed federally other than withholding tax or by a state. But the big ones, and this conversation's not going to be fully encompassing of what we need to know about state tax, very general conversation, but should give you an idea of the situations in which you'll need to file a state tax return. So one good example would be rental properties or just properties in general. So to the extent that you have rental income from a state, so let's say you have, rental properties in California and rental properties in Florida and rental properties in Oregon, you will likely have to file a state tax return to report that income. Now, of course, Florida doesn't have income tax at the state level, so you won't need to file an actual tax return in Florida. But for taxable estates, if you have rental income in those states, you will need to report that income. And once again, every state is completely different. So for instance, some states require that you report if you have a certain amount of gross income. Certain states require that you report if you have a certain amount of net income. Some, if you don't have any net income, you don't have to file. If you're below a threshold for gross income, you don't need to file. So you really need to look at each individual state whether or not you need to file your rental income on a state tax return. So that would be example number one. Example number two would be if you sell a property, it could be that rental property, it could be a piece of land, it could be any piece of property in the state. Same thing applies. Most states will want their piece of tax if you sell property in the state. So California is a good example. You sell your house, your rental property, a piece of land, anything you might have in California, you would need to report that on a non-resident state return, and you would only report that particular income. So if you had rental income and a property sale, you would report that in California, and that would be a reason to file a state tax return as a Canadian. Now, there's some unique situations like pensions in some states, which is not common. Often pensions are not taxable in a state to a non-resident of the state. And in some cases, business income, and that's quite a complex area of taxation, whether you're being taxed in the state due to earning business income, whether you're in the state, or if you're earning business income outside of the state. So you'd need to look at each individual state. We're not going to get into that today. And then in most cases, if you're earning employment income in a state, not from a state. So if you're working for, a California company in Victoria, BC, you likely won't be required to pay state tax. But if you're earning the income inside the state, if you're going down to California and doing the work, you'll likely be taxable in California. Once again, these rules can be quite complex. California is a great example. There are lots of rules around earning business income and employment income. So you really need to go through these rules to see if you're actually taxable on these amounts or not. So those would be cases where you would be taxable in a state, or at least need to report the income on a state tax return and file it with the State Department. And we'll talk about foreign tax credits and how those work after we get through this kind of third topic. So individuals in the US that are moving permanently to Canada. So of course we see this a lot with our clients, clients moving from Florida, from California, from Texas, from New York. When they move into Canada, often they'll move at some point in the year. Let's say they move June 30th. From January 1st of that year to June 30th of the year, they were living and they were tax residents of a particular state. Let's say they're moving from California to Victoria, BC. This is a permanent move. Once they enter Victoria on June 30th, they will be tax residents of Canada and no longer residents of California. So when these individuals move, and once again, these tax returns are not going to be due until the next year. So if this was in 2024, their tax returns for both federal, US, state, US, Canadian returns will all be due in 2025. But for state purposes, for California purposes, they were only a resident from Jan 1st to June 30th. So how do they file these state returns? Once again, I'm going to preface this with state returns can be quite complex. This is something you want to get lots of advice about. But generally speaking, the way this works is they will file an exit return from California, which is really just a non-resident return. So California will have two types of individual returns. They'll have a resident, regular California return for those that are residents of the state. And then they will have a non-resident return. So what you would do is you would have an exit return being a non-resident return at June 30th. So you would tax your worldwide income for California purposes from January 1st to June 30th. And then after that, you shouldn't be taxed on any income in California that is not California source income. So for instance, you leave June 30th, you move up to Canada. Let's say you start working for an employer. That T4 income in Victoria will not be taxable for California purposes. But once again, you have to do that return. So, we see this a lot on maybe self-prepared returns or even professionally prepared returns where somebody moves to Canada and then there's a full year California return that was prepared. And which means you have to go back, you have to amend the California return to have it be an exit return because California doesn't know that you've left. I mean, that's a big part of this. When you file these returns with the state, you're essentially letting them know that I'm leaving the state, I'm no longer a tax resident of the state, and that it gives them the opportunity to ask questions if they need to. Honestly, in most cases, they tend not to. California would be the one that would send probably the most tax inquiries out of all the states in our experience. But they tend not to ask very much. But this is the way, they know that you're no longer a tax resident of the state. Because if you didn't do that, if you just filed, let's say you filed a regular full year California return, but then only put 6 months of income on it, I mean, they likely wouldn't figure that out. But that's not a reason not to do it properly, obviously. In the next year, if you didn't file a California return, they would essentially ask you for the California return that you didn't file. Why did you not file it? So that's why it's really important to get really good advice on this. And I know it can be expensive, but often, a little bit more expense on the front end will save you a crazy amount of headaches going forward. I've seen some of these, especially some of these California files stuck in the system for really petty reasons for years. Just because somebody can't seem to get through it at the department. They're trying to get the information to sign these things. It can be absolutely brutal. So doing it properly initially, getting it out of the way, always a great idea. Okay, so those two main topics, Canadians with rental properties and capital gains in the US might have to file state returns. Individuals moving from the US to Canada permanently will have to file state returns, exit state returns. Oh, the one thing that I didn't mention, so for instance, the example, California to Canada, it's possible that you had a rental property in California when you left that you continued to rent. So you would have rental income from California for the whole year. So your worldwide income would only be taxable from January 1st to June 30th, but you might have rental income in California that will go the whole year. So just because you leave a state doesn't mean you don't necessarily have to file in that state anymore. If you have income from that state, you would have to continue filing. The difference being it would be a non-resident California tax return, 540 NR, and not a regular California return. Okay, so we talked about those two instances. Now let's talk about how you report these for Canadian and U.S. purposes. And I'll use the example of rental and capital gains, let's say. And we won't get into the entry to Canada example because that one can be quite complex because of the way the foreign tax credits work. Maybe we'll talk about that a little bit at the end. But for Canadians with, let's say you have some rental income and you sell a property in California. So you buy property, and let's pick some numbers. You buy a property for $1 million and you sell it for $2 million. You have $1 million capital gain in US dollars, and let's say you have $100,000 in rental income. So the capital gain gets reported on the California return, the rental income gets reported on the California return, and you pay whatever tax you pay in California on that income. For Canadian purposes, the capital gain will get calculated, but remember, we always have to convert capital gain proceeds and cost basis at the dates in which they were incurred. So if you bought that California property in 2005, that's the date at which the cost basis is going to get converted at. And when you sell it in 2024, you're going to convert it at the exchange rate at the date that you sold the property. So you're not taking the $1 million capital gain and multiplying it by 1.35. You have to do the conversion on both the cost basis and the proceeds. The rental income will get, in most cases, if it's spread out throughout the year, the rental income will get reported at the average exchange rate for the year. So once you've done those calculations, that income will get taxed on the Canadian return. Let's assume for this example that you're under the $250,000 exemption for the new capital gains rules, not to complicate things. You're only going to be taxable on 50% of the gain in Canada. So you'll report any income and calculate any tax that you need to calculate for Canadian purposes. And then the tax that you've already paid to the U.S. or calculated on the U.S. return will be a credit against taxes that you've paid in Canada. Now, in a lot of cases, California taxes tend to be high. You might not end up paying any tax in Canada on that income. But the key lesson here is you will get a foreign tax credit in Canada for the U.S. tax, that the state tax, and we're only talking about state taxes. There'll be a federal portion of that tax as well. So you'll report the rental income and the capital gain for federal purposes. So all that tax will be a credit to you on your Canadian return. In a lot of cases, wipe out all the Canadian tax. Once again, if you don't do that, you're paying a ridiculous amount of tax. You're paying California, federal, U.S., and Canadian provincial and Canadian federal tax. So foreign tax credits, really, really important, obviously. And then let me just finish on, how would that look for the individual moving from California to Victoria? That one's going to be a little bit trickier because if you assume that there was no California source income after the date of entry to Canada, there won't be a foreign tax credit at all because your Canadian taxation started June 30th. You have no foreign income, so there's no foreign tax credit. But if you use the example of the individual having $100,000 of rental income throughout the year, if any of that rental income is earned after June 30th, then you would have foreign source income on your Canadian return and you'd get a foreign tax credit for the tax you paid on whatever portion of that $100,000 was earned after June 30th, if that makes sense. Once again, a very, very complicated area of tax. We help lots of clients and have helped many clients in the past move from the US to Canada, with their tax filings, obviously, with our tax partners, but also with all their investment planning. I mean, that's a big part of what we do. And before individuals move from the US to Canada, a significant amount of investment planning is required really to make sure that, portfolios are set up and accounts are set up or done so in an efficient way and in a way to really minimize tax and mitigate any tax penalties. So if you need to talk about that or any other tax, cross-border tax items, feel free to reach out. Email below, easy to find me online. We offer a complimentary cross-border tax and investment consultation. The link will be below. Those fill up very, very quickly. So if you're interested, please jump on there. If you're not yet a member of the Americans in Canada Facebook group, we're almost at 10,000 members currently. Great community. Please join that community. Big thanks to everybody for their support, and we'll see you on the next one.